And finally, some good news for baby boomers and those nearing retirement. The surging stock market has helped push 401k balances to all-time highs. So how long will this last? Joining me now, financial panel, Alan Haft, partner at Kelly Haft Financial, Greg Melia, president of the Melia Advisory Group and Advisories Academy board member, and Bankrate chief financial analyst Greg McBride. Welcome all. Greg, I'll start with you. So we've got new balance figures out from Fidelity. They say they're up 12.9% to $91,000 on average. How meaningful is this? And do you think it's changing the habits of consumers?
The perceived wealth effect really isn't happening with the folks I talk to routinely. You know, in the late 90s, we had, people were spending, the markets were going up, and people were actually feeling wealthier as a result of 401ks, and consequently, we're spending more money. Today, you really just don't see that, and that's why we see consumer spending as flat, and we're not seeing really any major increases there at all.
Alan, you say it's time to take action.
Rebalance.
Yeah.
If you've been looking at your portfolio, it's probably been to both Greg's said that the balances have been going way up and people are feeling a little better about themselves. But you can't just sit idly and watching those portfolios. Now is a great time to rebalance the portfolios. If you don't understand what it is, look it up because it's a super important concept. And don't be fearful of the sectors that have been underperforming, such as Europe. This is a good time, especially if you have a longer time horizon for investing, to load up on the sectors that are not doing so well, because today's losers are often tomorrow's winners.
Well, there's always a turnaround in that. Greg McBride, I want to change the conversation to interest rates. This is a conversation that's critically important to American families. We feel it every which way. Mortgage rates, we feel it in our savings. When do we expect some kind of turnaround in rates? People have been forecasting it for years now, literally. What's your outlook?
Well, look, we've been in this ultra-low rate environment now for 6 years, Jerry, and counting. And, every year it's kind of like the refrain of the Cubs fan, next year, next year, next year, right? That, next year will be the year that rates go up. And look, maybe that pans out, maybe it doesn't. I think as far as consumers are concerned, you should be prepared for a rise in interest rates, whether that comes next year or not. Pay down variable rate debt, refinance into fixed rate obligations. From an investor standpoint, insulate yourself from higher rates by, tilting your bonds toward things like floating rate bonds and inflation index bonds. So be prepared for it. But again, I wouldn't pin all your hopes on the fact that rates are going to go up, because if the economy continues to languish, and at least in the eyes of the Fed, if inflation stays contained, they're not going to be inclined to raise interest rates.
Greg Melia, to you, do you agree? I mean, we have the example of Japan that had low rates forever and a punk economy for a long time. What's our future?
I think anybody that thinks that rates are going to come up tomorrow is ignoring Japan, because they've got a generation of baby boomers about 10 years ahead of ours. And when 2/3 of our economy comes from spending and that generation is retiring, well, as a generation retires, they tend to slow spending down.